Huh? Anybody? Any question, confusion? So can we start? If I am not wrong,
Yes, sir.
we are doing. Have we started this economic exposure?
Yes, sir. I think it's still slide number 9.
Slide number 9.
Yes, sir.
So real exchange at 8. So we'll start from slide number 9, or we have done till slide number 9. Anyway, let me just tell you this thing. Nominal and real exchange rate, I think we have done. So if nominal rates change with an equal price change, no alteration to cash flows, that also we have done. So we'll be doing from slide number 9. Or we have done till slide number 9. So can you see the slide?
Yes, sir.
So this we discussed, though, starting from this. So a real value, a decline in the real value of a currency. Basically, when your currency depreciates. So when your currency depreciates, so naturally what happens? It makes export more competitive. Naturally, we know that because our goods will be cheaper in the foreign market. Do you understand why it is? Any idea why it happens? Anybody?
Yes, sir.
How?
Sir, like if at all the currency depreciates, like if the rupee value is 75, if it goes to 76, then they will get for less than $1.
Yeah. So basic idea is, see, suppose this cup I sell for $1. Okay, why I sell for $1? My cost is say 74, and I make a profit of 1 rupee. So my selling price is 75, and $1 is equal to 75. Okay, so in the domestic market, my cost is not changing, but exchange rate changes to 76. Now, when I sell, now I want to sell it for 75 rupees. Okay, now $1 is equal to 76. Now I can sell it at a price of less than 76. So naturally, I gain the export competitiveness because I can sell this product in the overseas market at a price less than $1. Whereas my competitors, whose currency has not exchange rate has not changed, they're still selling it at the same price, that is $1. So I gain the export competitiveness if my currency depreciates. Not only that, similarly, import competitive goods become more competitive. See, for example, I am not exporting, but I am competing with the goods which are imported in India, like Indian tea and Sri Lankan tea. Okay, now basically, suppose Indian tea is 75 rupees a kilo. Now Sri Lankan tea, which is imported for $1, which was equal to 75, now that has become 76 now. Why? Because it is still imported for $1, and exchange rate now has become 76 rupees. So when you convert, the price of Sri Lankan tea will now be 76 rupees, whereas my homegrown tea will be sold for 75. So, sorry, one is it makes export more competitive. Similarly, it also makes the import competitive goods more competitive. On the other hand, an appreciating currency just do the opposite. So imports and export competitive goods becomes more competitive. So my imports become cheaper when my currency appreciates. So earlier $1 is equal to 75, now it is 74. So now I can import goods at a lower price. Similarly, my export competitive goods become more more competitive. Okay, the goods which I am exporting, so the goods which are competing with them, so they become more competitive. Okay, so that's the appreciating and depreciating currency in the simple term. So during the appreciation of home currency, exporters, if you are an exporter, you have two choices. One is, if you can keep your prices constant but lose sales. So if you keep your prices constant, if you do not change the price, you lose sales. Or if you adjust your prices to foreign currency, you maintain the market share but lose profit. What do you mean by this? So suppose I was earlier selling it for $1 and $1 was 75. Now since it has become $74 exchange, so I'll be now selling it for a price of more than $1. Okay. Now if I don't change the price, if I keep on selling it at a price which is more than $1, that is my point number 2, then what will happen? I have the same amount of profit, but I'm sorry, I have the same point number 1. I keep the price same, that is, I have the same amount of profit, but my market share will go down because I lose some customers. On the other hand, if I reduce the price, so naturally, what will happen? I can keep the same number of customers, but I lose profit. Okay, so both the cases we have to take a careful decision, because losing sale is bad. Similarly, losing profit is also bad. Okay, it's not that when you lose profit, it may not be possible for you to maintain the same market share. So if you can maintain the same market share, then only question of losing profit arises. Okay, so these are all difficult decisions for a firm to make. So summary is, the economic impact of a currency change depends on the offset by difference in inflation rates or the exchange rates in difference in inflation rate or the change in the real exchange rate. So okay, it is the relative change that ultimately determine a firm's long run exposure. So that we have discussed, it is not the nominal rate, actually it is the real change in the real exchange rate. So economic consequences of exchange rate changes. So what are the economic consequences? So the impact on operating exposure of a real rate change depends upon, number 1, pricing flexibility. We have seen that. What we have seen that, because whether you can change the price or not. That is just this slide we have seen that you have two choices. Either you keep the price constant on lose sales, or you change the price and lose profit. So depends upon the pricing flexibility. So another thing is price elasticity of demand. So price flexibility comes if the product is depends upon the price elasticity of the demand. Consider a case, if the crude oil prices go up. So in India, the price is inelastic. So people will buy crude oil. So there is no need to change the price. Okay, even if the exchange rate goes up. So forget about the change in the price of the crude. I am talking about the change in the exchange rate. So if the rupee depreciates, so naturally whatever oil we import, they will be more costly in India. So similarly, the oil exporting countries, they will probably not change the price in the international market, because almost they have a monopoly, because there is a cartel. They determine the price. But on the other hand, if you have a product which is price sensitive, so naturally you have to change the price, like what we have discussed in the previous slides. Next is degree of product versus others. So if your product is such which is unique, something unique, so naturally you will not be bothered about the price change, because you have fixed customers, they come to you because of the uniqueness of your price. However, if there is a substitute, they might also go for that. See, for example, let me tell you, there are certain cars, say Mercedes, BMW, these products are unique. So people who will be buying their cars, even if the exchange rate changes, they will be buying. But suppose you have a substitute, Close substitute. So you might check. If the company does not change the exchange rates, as a customer, you can shift. Similarly, it is also possible that the exchange rate between dollar and euro is changing, but exchange rate between exchange rate between Indian rupee and euro is changing, but exchange rate between Indian rupee and dollar is not changing. So it is also possible that for that also you can select a different company. Any question till now?
No, sir.
And last point is the most important: ability to shift production and substitution of inputs. So basically, what that is why all the companies, they are shifting their base to base to China, because the manufacturing cost in China is less. So that is why not only the US companies, the other companies in the world, they are also shifting their base to China. Initially, it is started by the Japanese companies, Japanese car makers. You know why? Late 80s. Why? Especially Toyota, Honda, these companies, what they had done initially when they started, they were capturing US markets, and not only that, when the cost of production in Japan had gone up, so they shifted their base to China. Now, slowly, if you see, the cost of production in China is going up. So some of the Chinese companies, they are also, shifting their manufacturing base to other companies, including India. Say, Xiaomi, there is MI phone, Redmi phone. They have their manufacturing base in India. Okay. So similarly, there are, iPhone probably very soon they will set up in other countries, because manufacturing cost in China has gone up. Okay. So this is whether you are able to do that, because it's just not only shifting the manufacturing base, but at the same time, your raw material must be available. Another is, this is ability to shift production. Another is the substitution of input. So one is availability of input, and whether you have you can bring input from other countries where the cost is less. Somebody please mute your mic. Brijesh. Brijesh 13D. Yeah. So another is substitution of input, whether you get a substitute or not. Plus, the cost is going up. So if the exchange rate goes up, so if you have a substitute in your country, okay. I don't know whether you have noticed it or not. Reliance is investing around $76 billion in green energy. So they are trying to find out a substitute of, lithium ion as well as cobalt. So they're trying to make battery, green energy that includes manufacturing of. What they are doing, manufacturing of battery, which will be used by the car companies. Now they are trying to use a substitute of lithium ion and cobalt, because either way you have to import these items, and the way exchange rate is going depreciating, it will be difficult for the company to make profit or compete with the foreign firms. Okay, because China they have a lot of stock of lithium ion. So if you import from China, and if the exchange rate Indian rupee depreciates against US dollar, whereas China, they have pegged their currency with US dollar. So naturally, China will get a competitive advantage over India because China is manufacturing. Chinese companies are procuring lithium ion in their own country where they are not affected by the exchange rate fluctuations. On the other hand, when they are exporting those batteries, it will be difficult for the Indian companies to compete, because for them probably they are not increasing the price, but as an Indian company, since Indian company is Indian currency is depreciating against dollars, so we will be, for our import cost will go up. So there is one way you can, there is one way to manage your, manage your economic exposures. Any question?
No,
So pricing flexibility is the key, whether you can change the price or not. That's the thing. So can the firm maintain its profit margins both at home and abroad? If the price elasticity of demand is low, the more price flexibility a firm has, naturally you can. And of course, availability of good substitutes. Okay, and don't think that you will change the price of only export, because if the foreigners can prove that in the home market you are selling at a higher price and in the you are exporting at a lower price, there can be an anti-dumping duty. So by this time probably you have done what is when anti-dumping duty can be imposed, etc., etc. So what are the options you have? One is product differentiation. So price elasticity depends on degree of differentiation. If your product is something unique, we have already discussed. So the greater the differentiation, the more the firm can control its prices, because if you can always say that your price is unique, your company is unique, which Mercedes-Benz does, or maybe BMW does. So these companies which are unique, like say Ferrari, so these are all unique products. So they can do even if their currency appreciates. So they can increase the price and maintain the same amount of profit, also the market share, by saying that their company is, their product is different from the others. Your home currency appreciates, the ability to shift production and to source inputs from other countries, because at this time, when your home currency appreciates, so you have the ability to import at a lower cost. That's this thing, what you call advantage, which happens during for the Japanese car makers in the late 1980s. So basically, operating exposure management requires long-term operating adjustments and the involvement of all departments. It is not only the production department, at the same time, by this time you have already seen the role of marketing department, role of product differentiation, role of invention of new products. So all these things taken together. Similarly, the production is definitely the most important thing, and sourcing of raw material. So sourcing of raw material is also very important. So all these things taken into account, you manage your operating exposure. Market selection strategy, you definitely try to select a market where you are not affected by the price change. So if it is a new market, nothing like it, use competitive advantage to carve out market share when currency value change. So I am exporting my goods in a country or in a market which is unexplored. So not my competitors are present there. So I can always definitely charge a price which is which suits me. Whether if I have, in that case, I will not be affected by the exchange rate changes. But if my competitors are, present there, so naturally there will be a problem. So I lose my export competitiveness if my currency appreciates. So if home currency depreciates, exporters gains competitive advantage by increasing unit profitability or market share. The higher price elasticity of demand, the more currency risk the firm faces by other product substitutions. Okay, so that's clear. So if the price is inelastic, so there is no problem. If the price is elastic, naturally, people will not buy your product and they will buy either your competitor's product or they will go for a substitute. So there are certain products, see, for example, if it is, we are talking about tea. So there is practically, if you see, coffee is not a substitute of tea. Yeah? Though, both are hot drinks and we prefer, but many cases we find, of course, if you don't get tea, probably you might get coffee. But many cases we find they are not substitute to each other. But here what happens is, if you're in this particular case, your main competitor is your is the other country's product. However, if you talk about Darjeeling tea, which does not have a substitute, so mainly our competitor, when you talk about Sri Lankan tea or Kenyan tea, they are competitor to Assam tea. So here your price elasticity, practically it is inelastic, because you have this product is not available in any other particular in any other place. So same thing, tea company, say Goodwick, which exports Assam tea as well as Darjeeling tea. For Darjeeling tea, it will not face any difficulties, but for Assam tea, it will face competition from Kenya or Sri Lanka. Is that clear? Make sense?
Yes, sir.
Product strategy. So if you launch a new product, when are you launching the product? Suppose you are launching the product at a bad time. Have you noticed anything that have you read in the newspaper that LIC, Life Insurance Corporation of India, is coming up with an IPO?
Yes, sir.
So the market is, a lot of people are giving, different views. A lot of people are saying one major, because it's a mega IPO, probably the largest IPO India has ever made. The valuation of the company is quite high, $6 to $8 trillion, 8 trillion rupees. So one of the largest IPO. The major reason is a lot of people are saying that institutional investors, they are selling their shares, keeping the cash in their hand, in which they can apply for LIC IPO. Okay. So there may be other reasons also, but one thing is sure, at this moment, if some small companies, they try to issue share, they try to go for an IPO, their IPO may not be successful. What is the logic or reason behind it? Because the entire market is ready to buy the shares of LIC. So at this moment, if you if you launch your IPOs, your means anything other than LIC, they may not be successful. That is the case here also. When are you launching your product? Whether the market timing is good or not. Suppose the market timing is not good. So in this case, your market timing will not be good when you launch your IPO along with LIC's IPO or along with an IPO which is so big. So timing of new product deletion. So if you see that you will not be able to complete, you can delete your product. And of course, product innovation. So you innovate a particular product which will definitely sold in the market. Anyway, having said that, product deletion may not be always possible. Let me also give you an example in this particular case. So we talk about product deletion. Suppose you are Goodwick. I'm talking about your company. You are exporting to US to your customers. They buy Darjeeling tea as well as Assam tea. Okay. Now, thing is, suppose you find Assam tea slowly it is becoming difficult for you to compete with others. So you think of deleting Assam tea. You think of only exporting Darjeeling tea. So your customer in abroad who was buying Assam tea and Darjeeling tea both from you, so may prefer to buy both the products from the same customer. So since Goodrick is now decided to discontinue Assam tea, they may not be interested to buy from Goodrick. So they might find a new supply. So that also you need to keep in mind, that whether the product which is where you are actually losing money apparently, if you discontinue the product, whether you will be losing the customers or not. So if you think about one major FMCG company, Unilever. So in India, Hindustan Unilever. So suppose they have, not suppose, they have I think 15 to 18 products in the soap and detergent segment. Okay. So out of these 15 to 18 products, some products they do not make profit. They lose money actually. So every product is sold, they lose money. But if they discontinue this product, their sale as a whole will come down. Why their sale as a whole will come down? Some companies, those 3 or 4 products, Procter & Gamble is the market leader. So if Hindustan Unilever discontinue their products, so some of their dealers might leave Hindustan Unilever, and they might start selling Procter & Gamble's product. So that is why, though there is a loss, but overall, since there is a profit, that is why they are still continuing with those products. Question, confusion?
No, sir.
So product management, input mix, shop the world, shift production among plants, so plant relocation, raising product. These are all normal common things which are possible. Planning for exchanges, develop contingency plan with plausible scenarios before the impact of a currency change makes itself felt. Basically, flexible manufacturing system. These are all different things which are, easy to say than do, because very easy to say that you go for a flexible manufacturing system, but it is difficult. So what is the financial manager's role? Structure the firm's liabilities in such a way that the reduction in asset earnings is matched by the corresponding decrease in cost of servicing liabilities. So on one side is your assets, on the other side is your liability. You have to use your asset, generate revenue, and serve the liabilities. Okay, now if your assets are not, they are not able to generate more profit or more revenues, then what will happen? How do you serve your liabilities? So it is the role of the financial manager to see that, the assets earning is matched by the corresponding decrease in the cost of servicing liabilities. So if your asset earning goes down, naturally your cost of servicing liability should also go down. This is basically nothing. You can leave this. So that's all about your operating exposure. Any question, confusion?
So what is the term shop the world? It was there in one of the slides.
What is the
meaning of shop the world? It was there in one of the slides. It was there in the last one. This one.
This one?
No, sir, back. 2 slides back. This one. 21, I guess. Slide number 21. Yeah.
Input mix, shop the world. So collect input from different parts of the world.
Okay.
So I have one more slide, but which one to do first? Let me do this first, then we'll have just transfer pricing. So this is basically how to raise funds in the international market. Can you see the slide? International financial market?
Yes, sir.
So what all instruments you have which you issue in the international financial market? That is, how do you raise funds in the international financial market? So you are talking about foreign direct investment. You are talking about foreign portfolio investment. Yeah. So all these companies they invest in the in our market. Say for example, LIC issue. A lot of foreign portfolio investors, they will buy the shares of the company. That is called foreign portfolio investment. You know the difference between foreign portfolio investment and foreign direct investment. Okay. Any idea about foreign direct investment?
Yes, sir.
What is that?
Like in foreign direct investment, people will come for the place in the board, basically for controlling purpose. So that's why they buy it with to get a place in the board, like the shares.
So yeah, right. They have a stake in the board of directors, in the management. Okay. So in India, so if you see in India, normally what happens is if you have a 10% worldwide, if you have a 10% or more stake, it is called FDI. But in India, there is no limit. So as long as you buy the shares not through the share market, okay. So share market, it is foreign portfolio investment. So not through the share market. If you buy the share either through IPO or through what do you call private placement, preferential allotment, any of the route, offer for sale, any of the route, it is called what do you call it? It is called foreign direct investment. Do you know what is offer for sale?
No, sir.
Do you know what is the public issue when the shares are sold among the public?
IPO, sir.
IPO. So LIC is going for an LIC is going for an IPO. LIC is selling 5% share. Okay.
Yes, sir.
So these 5% shares, two things. One is these 5% shares are sold by the LIC, or the 5% shares are sold by the promoters of LIC. In case of LIC, promoter is President of India or government of India. So if government sells its shares, it is called offer for sale. Suppose Reliance Industries Limited is going for a public issue, where company is selling. The company is a separate legal entity. So company can sell its shares, and Mukesh Ambani can sell its shares also. Okay. So in the promoter, existing shareholders sell their shares through this kind of offer. It is called offer for sale. On the other hand, when the company sells shares, it is called public issue. So suppose Reliance decides that it will sell 5% share to, say, Amazon. So this will be, if Reliance sells the share, it will be private placement. So privately placed. Okay. So what is a private placement? When you sell the shares to a particular person, private placement. 2021, Reliance sold, Reliance had gone for private placement to, I think, Google, to Facebook, all these companies, Reliance sold shares. These are all private placement. So it did not sell share to the general public, but it sold shares to some people. So that is what is called private placement. Okay. On the other hand, if Reliance decides to sell the shares to general public, it is called public issue. So in a public issue, it is also possible that you give shares on a preferential basis to a particular entity or a particular person. It is called preferential allotment. So in a public issue, if you as an individual investors or as a retail investors, when you apply, you may not be allotted any share. Okay, but when it is a preferential allotment, naturally you will be allotted shares. Okay, so that is what is called. That is what is the difference between preferential allotment, private placement, and with the public issue. An offer for sale is when the existing promoters, they sell their shares. Yes, question.
No, sir.
Sir,
Clear?
I had a question, sir.
Sure.
So I wanted to ask, aren't all IPOs a part of offer for sale?
No.
So, what are
Many
the
cases we find that existing promoters, they also offload their shares. See, for example, Paytm issue. So company issue, if it is an offer for sale, the money goes to the promoter. If it is a public issue, money goes to the offer for sale can be among the public also. Offer for not necessary offer for sale will be always to a particular person. Offer for sale can be a public also, public issue also. So when the money goes to the company, it is public issue normal. When the money goes to the what do you call a particular to the existing shareholder or promoter, it is called offer for sale. It is also possible a public issue is a combination of public issue and offer for sale. So suppose it is the company is selling 1 million share. The company is selling 1 million share. Out of the 1 million, share, say 75,000 is public issue and 7.5 lakhs is public issue and 2.5 lakhs is offer for sale. Existing promoters, they are selling their share. So in case of Paytm, I told you it is a combination. LIC I have not seen till now. I have not seen whether it is offer for sale or not. I think government is selling the shares. It may be.
LIC is
probably it is offer for sale. Probably it is an offer.
Yes, sir, it is offer for sale.
Yeah.
So, but I'm getting confused with the fact that when a company goes for funding or through an IPO, they are essentially selling their ownership, right? So, isn't that promoter selling their ownership?
Let me tell you. Suppose a company can issue up to 10 crore share. That is called authorized share capital. So that is mentioned at the time of incorporation. Okay, not necessarily company will be selling 10 crore shares. Suppose the promoters has other distinction, promoters has 4 crore shares. The company has decided to sell another 1 crore share. Okay, so this 1 crore into the price of the share, that money will be in the company's book. However, if out of their share of 4 crore, if the promoters decide to sell 1 crore share, now promoter shares will be now 3 crores. So what is the difference? In the first case, promoters have 4 crore shares and company is selling another 1 crore. So total share capital of the company will be 5 crores, of which promoters have 4 crore, outsiders have, others have 1 crore. Public maybe other, so total 5 crore. But if it is an offer for sale, out of 4 crore shares, promoters sell 1 crore share, the total share capital remain as 4 crores. Okay, this money on 1 crore will not go to the company, that will go to the promoter. Make sense?
Got it, sir.
Sir, so in public issue, basically promoters' stake will get diluted, right?
Absolutely. Offer for sale also, promoter stake will be diluted.
Yes, sir. But the promoter will get the money.
Promoter will get the money. Anything else? So, in how do you raise money in the domestic market? You have equity share, you have preference share, you have debenture, you have different other debt instrument. You can borrow from bank and financial institutions. But in the international market, you have different instruments. So the most important instrument which you can apply is called external commercial borrowing. We'll come to that. So first, let us talk about euro currency market. What is a euro currency market? Let me tell you. Dominant currency is US dollar. So when dollar is traded or raised outside US, it is called euro dollar market. I repeat, when dollar is traded outside US, it is called euro dollar market. So an Indian company borrowing in dollar outside US, it's called euro dollar market. So suppose an Indian company is borrowing from Citibank London. Though Citibank is a UK company, in a US company, but if the money is, because Citibank London is a different subsidiary. So money is borrowed from Citibank London. So money is raised outside US, but it is in US currency. It is called Euro currency market. So composed of basically Euro banks who accept, maintain deposits and lends foreign currency. So dominant currency is US dollar. What is US dollar deposit or borrowing in London or Singapore or Hong Kong is Euro dollars. So as I have told you, that is as long as it is outside US. Dollar outside US is Euro dollar. Not necessarily it will be in Euro. So these deposits can be in a foreign bank in a foreign country or a domestic bank in a foreign country. As I have told you, that is, it can be Barclays Bank, Deutsche Bank, all these bank in a foreign country that is outside US, or maybe an US bank in outside US. So it may be Deutsche Bank or all these banks in either in Germany or in London or whatever it is, or it can be Citibank in London. Growth of euro dollar market. So caused by restrictive US government policies, especially reserve requirements on deposits, special charges. So this you can leave, it is not applicable for India. Euro currency loan. London Interbank offered it, I told you. Have I? Oh, yeah, we have discussed. So it is no,
Yes, sir,
no more. It's not there. So basically that was the rate which was applicable. Mostly these loans are floating rate. However, there are fixed rate loan also. So there sometimes you can also borrow in multi-currency. So the borrower has the option to switch currency of loan at rollover. Currency of loan at rollover. Suppose you borrow in dollar for a period of 1 year. As so I have told you, that you have the choice of borrowing in one currency and repaying in another currency. That choice also you have. Along with that, suppose you borrow in dollar, after 2 years you roll over, that is you extend the loan. So at the time of rollover, you can change the currency. That is also possible. So depending upon your exchange rate risk. So depending upon exchange rate with those two particular currencies. Okay. Similarly, there is another thing also possible. A company, an Indian company can issue multi-currency bond. What do you mean by multi-currency bond? That means you will be issuing a bond which will be traded in different markets. Different markets means more than one market with different currencies. Okay, suppose it can be issued in Singapore, it can raise Singapore dollar, it is issued in Germany, which can raise euro dollar. So these are also possible. So there are different things. So domestic versus euro currency market closely linked. You can also leave this. You can also talk about domestic market versus international market. So naturally, one thing you can understand, we have done covered interest arbitrage, and we have seen that is we can also arrive at a forward rate. So this is cheaper as long as, I repeat, when you borrow in foreign currency in the foreign market, if you have to pay in a particular foreign currency, then it is different. Otherwise, when you borrow foreign currency in a foreign market, it becomes cheaper when interest rate very low. Okay. Now interest rate is always low in this market. Then why you do not borrow always? The reason is very simple. When you borrow, you have to go for a forward cover. What is a forward cover? That is when you, at the time of repayment, if your currency depreciates, so naturally you will be suffering a loss. So how to protect yourself from this? You buy a forward contract. So you buy a forward contract. So when you buy a forward contract, there is a forward premium. What do you mean by this? Suppose today when you borrow, $1 is 75. Okay. So after 1 year, when you repay, so suppose that exchange rate is 77 and you don't know what is the exchange rate. So what you do, you enter into a forward contract where you buy your loan as well as including interest after 1 year. Okay. So when you buy in the forward market, so you pay normally, when your rate of interest is more, so your currency will be trading at the foreign currency will be trading at a premium. So you find out the foreign difference in how much is the premium of the in the forward market and what is the gain you have by borrowing at the borrowing in the foreign currency in the foreign market. So if you see that the premium is, forward premium is less than the differential in interest rate, then it is profitable. If you see the forward premium is more, then it is no more profitable. Okay, so that is the basic rule. So, what is the definition of Eurobonds? Bonds sold outside the country of currency of denomination. Grown very fast, recent substantial market growth due to use of swaps. You remember what is a foreign exchange swap? Today you borrow. Once you borrow, you bring the money in the market, sell it in the spot market, the foreign currency, and buy it in the foreign market. The Eurobonds are always linked with the domestic bonds market. Otherwise, there will be an arbitrage. I told you that is forward premium must be equal to the interest rate differential. So sometimes when you issue bonds, it is underwritten by syndicate of banks. So instead of selling directly to the overseas customers, you appoint some investment banks. They will help you to sell the bond. In many cases, they can buy the bonds and then they sell. So Eurobonds are most of the, as I've told you, US dollar is the dominant market, and etc. etc. Remaining part is not that credit rating, all those things. So mostly these things are also applicable in Indian market also. So there is a difference between Eurobond and Eurocurrency loan. Eurocurrency loans use variable rates. Loans have shorter maturities, bonds have greater volume, loans have greater flexibility, loans obtained faster because you borrow from a particular bank or a financial institutions, okay, or maybe a consortium of banks, and loans may not be traded, but bonds will be traded, definitely traded. Any question, confusion? This is another substitute, another instrument, note issuance facility. It's a low-cost substitute for loan, allows borrower to issue own notes, please distributed by banks. This I will again go at the last. NIB versus Eurobonds. What are the differences? Notes drawdown credit is needed, etc. etc. Notes late owners. So some we normally Indians. Indian banks and Indian financial institutions, either they go for bonds or they go for loans. Commercial paper, Euro commercial paper, these are all short-term financing. You can just go through. The most important one is external commercial borrowing. Have you heard about it? Yes or no? Heard about external commercial borrowing?
No, sir. Like I heard the word, but I don't know the definition exactly.
It is the most popular loan instrument with which the Indian companies, they can borrow in the overseas market. Okay. So whenever you borrow in the overseas market, it is called external commercial borrowing. So there are a lot of things, a lot of restrictions. So external commercial borrowing are commercial loans in the form of bank loans, securitized instruments. So for example, floating rate bond or fixed rate bond. So if Reliance takes a bank loan, it is external commercial borrowing. If Reliance issues bond among public in the overseas market, NRIs or foreign nationals, it is also external commercial borrowing. So non-convertible, optionally convertible or partially convertible preference shares, they also come under external commercial borrowing. Buyer's credit, supplier's credit availed from non-resident lenders with a minimum average maturity of 3 years. So time is important. Any question?
No, sir.
So ECBs are permitted by Government of India as a source of finance by Indian corporates for expansion of existing project as well as for new investment. Okay. The main objectives of ECBs are to provide an additional source of. I told you at the beginning on the first day that India is a country which lacks capital. Okay. So since we need capital and our domestic market is not enough to provide that capital, so government always encourages companies to borrow in the foreign market. And now, of course, though it is written at the end that is SME scam, but it is actually not possible for the small businesses to borrow in the overseas market. There are a lot of restrictions, there are a lot of rules and regulations which you have to follow. So that is why it is the big corporates normally which borrow in the overseas market. So they borrow either for their existing project or for new investment. And it also provides an additional source of financing at a cheaper rate. The Government of India encourages ECBs in the infrastructure sector like power, telecom, roads, railways, urban infrastructure, etc. Also ECBs. So external commercial borrowings are different from foreign direct investment. Okay. Yes or no?
Yes, sir.
So basic idea is foreign direct investment is in the equity, in the form of equity, where you have a stake. And external commercial borrowing, it is a loan.
Yes, sir.
Anybody any question?
No, sir.
So what are the areas where government normally encourages? Telecom, roads, railways, urban infrastructure, etc. and also SMEs. So they can be accessed under automatic route and approval route. When ECBs are for investment in real sector, industrial sector, infrastructure sector, and specified service sector in India, they are under automatic route and do not require approval from RBI. But there is a limit. Earlier it was $500 million, now it is $750 million. So under automatic route, so these are the sectors where it is under automatic route. So earlier limit was $500 million. Otherwise, now it is $750 million. So you don't need an approval from the Bank of India. So ECBs are different from foreign direct investment. ECBs are not equity funding. When the foreign investment comes in the form of equity capital, it is termed as FDI. So apart from cheaper cost of borrowing, ECBs also have some more advantages like diversification of investors base. It also helps the company to have international recognition. So what do you mean by international recognition? When you borrow in the overseas market, naturally the foreign investors, they will come to know the name of your company. Any question?
Sir, I had a small question. Like, in what circumstances we the government will go for like ECB, and what circumstances will go for FDI?
It's not government which is going for FDI or ECB. Suppose Reliance Industries Limited, okay, or Tata Steel, it wants to raise money in the overseas market. Okay, but my point.
Yes, sir.
So if you borrow money, it's a loan. If you issue, you can also issue equity share in the overseas market called EDR, GDR. We'll come to that later. Okay. So when you issue ADR, GDR, they are basically FDIs. Or when they buy directly, you don't have to issue ADR, GDR. So suppose some foreign companies buy shares in your company, foreign direct investment. Or say you have heard about Tata AIG. Yes or no?
Yes, sir. Yes, sir.
So Tata AIG, it's a case of what do you call? It is foreign. It is foreign direct investment. Okay. Now suppose this Tata AIG wants to raise money in the overseas market. It becomes borrows money in the overseas market. It becomes external commercial borrowing. Got it? External commercial borrowing is a loan. And foreign direct investment is not is equity. Huh? Now, question is, it will be decided by the company. Now, here what we are discussing is external commercial borrowing is the borrowing in the overseas market when government encourages overseas. Why government encourages external commercial borrowing? The reason is government knows that the fund available in the Indian market is limited. Okay, so that is why, and you know, if the big companies, because the small companies, especially SMEs, MSMEs, they cannot go for external commercial borrowing because first of all you need a high credit rating. It must be a known company. In the overseas, everybody now in the world they know about Reliance. Okay, so if Reliance or Tata's, and similarly many other companies. So if they issue shares in the or if they borrow in the overseas market, it will be easier for them to borrow at a cheaper rate. Okay, that may not be the case for MSMEs or SMEs. Question clear? So it is a company's call whether they will borrow or they will issue equity. Okay? Is that clear? Huh?
Yes, sir.
Yes, sir.
So ECBs are different from foreign direct investment. ECBs are not equity funding. When the foreign investment comes in the form of equity capital, it is termed as FDI. So as I've told you, that is ECBs also will give you some international recognition. So external commercial borrowings are increasingly used by corporate India to fund infrastructure and other projects at a lower cost. However, ECBs are, if you borrow, naturally company's debt will go up. And company is an Indian company, so total India's debt will go up. Yes or no? Huh? Is that clear? If you borrow, your debt will go up.
Yes, sir.
Yes, sir.
So if India's debt as a percentage of GDP goes up, what will happen?
Sir, we won't be able to borrow like in the future. It will
No. So our credit worthiness will go down. Is that clear?
Yes, sir.
So naturally, the government of India will not like it. Huh?
So yes, sir.
So when you on one side you are encouraging external commercial borrowing, on the other side you are saying that if you borrow more, then the debt GDP ratio of the company of the country will go up. Okay, so what to do? So that is why if the government of India has a limit of external commercial borrowing, limit of external commercial borrowing means how much the country can borrow as a whole. That is decided by the government. But out of that, how much can be external commercial borrowing? That will also be decided by the government of India. So in any particular year, what will be the limit of external commercial borrowing that is decided by the government? In fact, it can be changed also by the government in between, depending upon the situation and requirement. Okay, so total amount of external commercial borrowing by taking all the companies together is fixed in a particular year. So ECB is also increase country external debt and it will also increase the borrower's foreign exchange rate risk. When you borrow in foreign currency, you have to retain foreign currency. So naturally, if the exchange rate changes in the future, it will be difficult for you to pay. So therefore, the saving interest cost might be eroded by the loss which may arise due to foreign currency fluctuations. So that is why there is a cap on ECBs in a financial year, and there is an overall cap on ECBs in different sectors. So one is how much is the total ECB by all Indian companies taken together, that is fixed. So as I told you, government encourages external commercial borrowing in certain sectors. Those are the sectors where there is the limit is slightly more, but otherwise for all sectors there is a limit. Suppose pharmaceutical sectors, government decides that this will be the limit of external commercial borrowing. However, remember one thing, once you fix the limit, it is not that this limit will remain forever. Okay? Like the total external commercial borrowing, total amount of external commercial borrowing in a financial year is fixed, and it can be changed from time to time. Same is the sectoral cap. So in a particular sector, how much you can borrow and total, and what is the total. Similarly, there is individual company wise also there is a limit. So before I go to foreign currency convertible bond, the next item, any question on external commercial borrowing? So it can be of two things. One is you are borrowing in the overseas market by issuing bond, or you can also borrow from the banks or financial institutions. Any question?
No, sir.
Achha, can you give me a break of 2 minutes, washroom break? I'm just coming back. Okay. 2 minutes, washroom break. Yeah. So later on, I'll also show you certain other things on these instruments. So after external commercial borrowing comes the foreign currency convertible bond. That's also very popular. So you know convertible bonds. So initially they are bonds, but later on they will be converted into equity. So foreign currency convertible bond is a bond issued by an Indian company in foreign currency, that is other than the Indian rupee. The interest rate on the bond is also payable in foreign currency. These bonds can be converted into equity shares at the time of maturity. The FCCBs must be issued in accordance with the issue of foreign currency convertible bonds and ordinary shares through depository receipt mechanism. This depository receipt mechanism, I will explain you when we will do ADR and GDR. Okay. So again, through depository receipt, there is a ceiling of issue amount of $750 million. So this is $750 million in a particular year. Okay, one financial year under the automatic route. Okay, looks very good, but it is not actually that good, because in this case, the investors, they have an option that whether they'll be converting their bond into equity share or not. So there are a lot of Indian companies which were into trouble. So you'll see I have names of those and cases also. The foreign currency, they must be subscribed by non-residents in foreign currency. The investors have the option of, the investors have the option of converting them into ordinary shares. It will not be compulsory of the issuing company in the future at a price determined by the issuer at the time of issue. Suppose today you issue one bond costing whose face value is $50. Okay, and it is mentioned that at the time of conversion, suppose say 3 years from now, it will be converted into 10 shares of your company. So one bond is $50. What is the price of one bond? If you see in Indian rupee, 50 into say around 75. So that will be the price. That is the amount which you are getting. But the investors, they will be buying in dollar. Okay. What about conversion? So at the time of conversion, they will be either given shares. Just now I have told you, suppose 10 shares. So suppose the market price of each share is, can you see the calculator?
Yes, sir.
Suppose at the time of conversion after 3 years, market price of each share is say 10 shares. I said na 10 market price of each share is say 350 rupees. Okay, you will be getting 10 shares. So what is the market price of 10 shares which you are getting? 3,500. Any question?
No, sir.
No. But at that time, exchange rate is suppose 80 rupees, and investors will get back $50. So what is the price? 50 into 80, 4,000. Will you be interested? If you are an investor, you will get back 50 rupees. If you convert that into Indian rupee, so the total is becoming 4,000. On the other hand, against this 50 rupees, you will be given 10 shares, and at that time, market price of each share is 350 rupees. So equivalent amount is 3,500. What will you do?
So we'll take the amount. We'll not go for equity.
You will not convert your bond into equity. Is that clear? So
yes,
that is what has happened with many companies in the past. So initially, when you were issuing shares, when you were issuing convertible bonds, because these bonds are normally one major reason for issuing convertible bonds, they are carrying even lesser amount of interest. So, and one way to avoid exchange rate risk. Why exchange rate risk is, today you are issuing bonds and receiving foreign currency. at the time of repayment, you don't actually repay. Instead, you give them shares. And how many shares you'll be giving them, that is determined today. So one way to manage the exchange rate risk is to issue foreign currency convertible bond. But you see there are certain examples where I will show you which are the companies which defaulted where the price was less. So naturally the investors, they did not go for external commercial borrowing. See, the investor have the option of converting them into ordinary shares of the issuing company in the future at a price determined by the issuer at the time of issue, either fully or partly on the basis of any equity warrants attached to the FCCB. So if you produce the warrants, you will get equity share. If you do not produce the warrants, you will get back money. Most of the FCCBs are unsecured and carries a coupon. Coupon means they carry a fixed rate of interest. So at the time of maturity, if the market price of the share is less than the conversion price, the investors have the option of redeeming the bond and not to convert into equity of the company. During 2006-08, when the stock markets were in boom, many companies found it very cheap to raise money through FCCB. All these were due for redemption during 2012-13, when the market was down. Therefore, investors were not interested to convert their bonds into equity. At the same time, rupee also depreciated against US dollars, which made it very difficult for the issuer companies to redeem the bonds. So, as a result, many of them defaulted. Okay? So, many companies, Essar, have you heard about that name? Essar? Essar Shipping? They defaulted. So, you'll see there are some more examples. Wockhardt, heard about that? Bought by Fortis now. Wockhardt was a company, they had hospitals, it also manufactures medicine. Ever heard the name of the company?
Yes, sir.
Defaulted in its FCCB payments in 2009, and the bondholders filed a winding up case, which was going on for a long time. Ultimately, the company agreed to pay the amount in 5 installments. So naturally, when you pay the amount in 5 installments, the bondholders also agree to that. Huh? Otherwise, it was not possible. Many other companies defaulted during the same period when the stock prices were down and the investors refused to convert their bond into shares. Some companies like Subex has raised $135 million to repay FCCB holders. Orchid Chemicals also raised $100 million through external commercial borrowing in order to repay FCCB, because they are not, the FCCB holders are not converting their bonds into shares. So naturally, they borrowed money in order to repay them. That's a problem. This is a famous case. Welspar Corporation wanted to buy back the FCCBs, but bondholders are not ready to sell at a discount. Now, buyback means suppose the price was $50. The example which I've given, the Welspar said, okay, I'll pay you, but you accept a haircut. In finance world, this is popularly known as haircut. That is, they borrowed $50, but they will be repaying a lower amount. That is, say, $40, which is at a discount. Okay, bondholders are not ready. So it may be noted that at this point, the repurchase of FCCBs were allowed by RBI from December 2008, subject to certain conditions. Zenith Infotech is one of the major case, had negotiated with the bondholders and extended the repayment time. Many other companies convinced the bondholders for a rollover of debt. Okay, but there are the exceptions also. On the other hand, HDFC Limited issued FCCB worth 500 million in September 2005. The bonds were to be convertible into equity shares of the company between August 2006 and July 2010. Otherwise, they are to be redeemed at maturity in September 2010. Okay, September 2000. So, what is the condition? They issued bonds, if foreign currency convertible bond worth $500 million in September 2005, with a condition that they will be converted into equity share between August 2006 and July 2006, depending upon your availability, your luck. It is done in lottery installments. But if they are not converted into shares within July 2010, then the company has to pay back money by September 2010. However, the entire issue was converted into equity shares on different dates by July 2010. Okay. Any question? Somebody?
Yes, sir.
Yeah. Bolo.
Sir, if at all FCCB holders want to go for equity, then how will the company manage? Like, will the company manage through buyback? Like, if at all it is trading in the
See,
Sensex?
first of all, at the time of issue, it is given against your bond how many shares will be issued. Okay. Now, normally it is done on a fixed date. That is, fixed date means or not on say 17th of February. So between this date, the company will convert. So the day till the day of conversion, you will get interest on your bonds. Okay. So suppose company decides that, like in case of in the previous case between July 2006 and between August 2006 and July 2010. So almost say 10 years. 7, 8, 9, 10, 4 years, almost 4 years, 4 years. So within these dates, suppose there are, they raised, I think, $500 million. Huh? So $500 million, suppose they decide that within this period of 4 years, every year they will redeem $125 million average. So that will be decided on the basis of lottery. That is, who all, because $125 million is not bought by one single investor. So there are many investors. So suppose they decide by lottery, it will be decided who will be, whose bond will be converted. So like we have cases also where suppose you started converting your bond. So initially some you have converted and some they have not opted for conversion. They are asking their money back. Okay, depending upon the condition. So however, in this case, what happened? So you are given a chance. So suppose the company says you receive a message from the company, your bond will be converted on such and such date. If you don't want to convert your bond, you can also, of course, you can wait till maturity where you will get back your money. Otherwise, if it is converted, as per our agreement, it will be converted into so many shares. So accordingly, you produce your warrant. Once you produce your warrant, naturally, your bond will be converted into shares. Question? Is it clear?
Yes, sir. Like, I have a question. Like, if at all the cumulative shares account up to around 1 million by any chance, like all the how will the
some of them are already converted, and after that the price falls. So remaining shareholders they refuse to convert. Possible.
Yes, sir. Sir, let us take a hypothetical situation wherein company needs to give 1 million shares for FCCB. So in that case, will the company go for a buyback?
Where is the question of buyback here?
No, like how will it issue? Will it issue because like how will the company process it?
Now, if you think about the balance sheet of the company, so in the balance sheet, suppose you have what do you call? You have a liability side, you have an asset side. So on the liability side, you have bond now. So if when the bonds will be converted to equity shares, so the value of bond will come down, the number of equity shares will go up. Simple thing. It will not be the equity share will not be issued by the promoters. It will be issued by the company itself.
Yes, sir. But I read a concept wherein if at all the employees of the company they can buy the shares of the company at a discount. So for that, the company will buy back from the market and they will give it to the employees so that
something else, ESOPs.
Yes, sir.
That's different. That's different. Yes. See, for example, this buyback, a company can, because as soon as it will be converted into shares, okay. So naturally, when it is converted into shares, naturally number of shares in the company will go up, and promoter stake will be diluted. Later on, company to reduce the stake, to increase the promoter stakes, company can buy back its shares, which is a common case. See, for example, now if you see TCS is buying back its shares for the simple reason.
For a premium, sir, 4,500.
Yeah, normally when you buy back at a premium. Otherwise, why should the shareholders sell? Now, why TCS is buying back shares? We talk about Tata Steel acquisition of Coras. Okay, you also remember? I told you in the book also there is a case on Tata Steel acquisition of Coras. So when Tata Steel acquired Coras, at that time, Tata Sons, which is the parent company of all the Tata groups, they issued a convertible debenture. The money was raised by Tata Sons in order to finance the acquisition of Coras by Tata Steel. But these convertible debentures were converted into shares of TCS. Okay. So basically, TCS is the most valued company of Tata Group in the market. So that is why they were converted into shares of TCS. Money was raised by Tata Sons. Okay. So naturally, when they were converted into shares of TCS, number of shares in TCS had gone up at that time, and promoter, that is Tata Sons, stake in TCS has also gone down. So now that is over now. So now slowly TCS is buying back its share in order to increase the promoter stake. So there are a lot of other reasons for which one company can buy back its shares, but the major reason, which definitely is not mentioned, is to increase the promoter stake in the company. Okay. So in case of an FCCB, if the company thinks that its number of shares, after the conversion, suppose the number of shares goes up and promoters, they don't want to reduce their stake below a particular level, so they can the company can always buy back shares. That is possible. What you are saying, at least, so that is possible in that way. Question?
Yes, sir, clear. Like, so there is one doubt. In IPO allocation, will it be purely lottery based, or else some algorithm will run behind?
See, it is lottery means it is not that anybody and everybody will be at the basis of lottery. So first there are groups in the sense lot-wise group. Suppose when you apply in an IPO, you apply in lots. So suppose the lot is decided on the basis of the price of the share. Okay. So suppose the lot size is 100. So you have to apply in 100, 200, 300, 400, and so on. So for 100 lot, there is one lottery. So first one is, and lottery in the sense depending upon the number of applications. So depending upon the number of applications, it is number of times it is oversubscribed in different groups is inversely proportional to the number of times it is oversubscribed. Suppose one issue is oversubscribed by, say, simple case, 3 times. Okay, clear? So out of every 3 shares, 3 applications, one will be allotted. Yes or no?
Yes, sir.
So first one is a lottery picked up in front of many people, many SEBI nominee, stock exchange nominee, etc. Suppose first number comes 7. So 7 will get a share. 7 means folio number, that is application number. 7 will get a share, 8 and 9 will not get, 10 will get a share. 11, 12 will not get, 13 will get a share, and so on. Got it?
Yes, sir.
So these are all done systematically. If there is any discrepancy, issue will be cancelled.
Yes, sir.
So this is about this. Foreign currency account issued by an Indian company and facing difficulties at the time of redemption is allowed to refinance by designated category 1 authorized dealers or banks under the automatic rules. That means you borrow money and repay, subject to certain terms and conditions laid down by RBI. However, if there is a proposal to restructuring of FCCBs, it can be considered under the approval rule. Proposal for change of conversion price is not allowed. Okay, suppose you said initially that I'll give 5 shares, now you want to reduce it to 4 shares or 6 shares, that is not possible. So then comes foreign currency exchangeable bond. So in case of a foreign currency convertible bond, suppose Tata Steel is issuing foreign currency convertible bond, the shares will be converted into the bond will be converted into shares of Tata Steel. But in case of a foreign currency convertible bond, Tata Steel issuing foreign currency exchangeable bond in the overseas market, bond will be converted into shares of Tata Steel Europe, so a subsidiary. Okay. So FCBs are bond issued by an Indian company in a foreign currency where the interest and principal repayment will be in the foreign currency. Subscribed by a non-resident Indian in foreign currency, converted into equity shares of another company. Now, when Tata Steel is issuing a foreign currency bond, it cannot be converted into shares of Amazon. It has to be converted by, of course, a sister concern. Converted equity shares of another company called offered company, other than the issuing company, either wholly or partly or on the basis of any equity-related warrants attached to the debt instruments. So remember, this offered company has to be related to this parent company. So FCBs are denoted in any foreign currency which are freely convertible. The offered company must be a subsidiary of the issuing company, and at the time of issue, but foreign currency exchange bond, the issuing company must hold shares of the offered company. So it's not that now Tata still issuing shares and it is thinking of acquiring one company. Say Tata Steel is thinking of acquiring, say, Amazon. Okay. Now Tata Steel says that today I'm issuing shares. It will be converted into shares of Amazon, and Tata Steel presently does not hold any shares of Amazon. But by the time conversion date comes, we'll buy shares of Amazon. That is not possible. So on the date of issue, this company, issuing company, must have shares of the offered company. The offered company must be a subsidiary of the issuing company, and at the time of issue of FCB, the issuing company must hold shares of the offered company. The offered company must be listed in a recognized stock exchange and must be eligible to receive foreign direct investment, because as soon as you, in the foreign previous case also, that is foreign currency convertible bond also, as soon as the bonds are converted into shares, it becomes foreign direct investment. Foreign direct investment has to be, I told you, in the form of shares. So if it is when foreign direct investments, when you issue foreign currency convertible bond, it is not foreign direct investment. But however, when it is converted into share, it becomes foreign direct investment. So similarly, when these companies' shares are converted, it becomes a foreign direct investment. The offered company must be issued in a recognized stock exchange and must be eligible to receive foreign direct investment, eligible to issue foreign currency convertible bonds or external commercial bonds. An Indian company which is not eligible to raise money from Indian securities market or debarred from raising money from the Indian capital market by SEBI are not allowed to issue foreign currency exchangeable bonds. Similarly, subscriber or FCBs must comply with the foreign direct investment policy and stick to the sectoral caps at the time of issue. At the time of issue of foreign direct investment policy and stick to the sectoral at the time of issue of FCCBs. What do you mean by sectoral caps? I told you at the time, external commercial borrowing. So whenever a company, every year, there is a sectoral cap, that is which sector can receive how much external commercial borrowing, that is decided by Government of India for a particular financial year. Similarly, total for external commercial borrowing is also fixed by, in a particular year, is also determined by the Government of India. So it must come under this. Okay. See, for example, this year's for external commercial borrowing is already full. So this year, no company can borrow additional amount unless it is decided, unless it is increased by the government of India. That is mainly RBI has it, but definitely RBI works under government of India. They must obtain prior approval from Foreign Investment Promotion Board wherever required under the Foreign Direct Investment Policy. Entities who are prohibited to buy or sell securities by SEBI are not permitted to subscribe FCBs. Masala bonds is the new kid in the Indian market. Okay, heard about it?
Yes, sir.
Yes, sir. In corporate finance, but unable to recall properly, sir.
So if you are asked in the interview, then you'll say that you have heard about it but unable to recall. So they are one thing you can make out. The name masala comes from Indian cuisine. So they are rupee denominated bond but settled in dollar. Let me explain, then I'll give you an example. Masala bonds are issued in offshore capital markets, that is outside India, but denominated in Indian rupee. They are issued to international investors to raise Indian rupee, but issued and settled in US dollars. These bonds are issued by entities to fund infrastructure projects in India, but the first issue was by International Finance Corporation. IFC issued 10-year, 10 billion, that is 1,000 crores Indian rupee bonds in November 2014 with a yield of 6.35% and AAA rating. These bonds are issued and listed in London Stock Exchange. The name masala bond came from the culture and cuisine of India. So what is the biggest advantage? See, let me give you an example how it is done. Today is 21. So suppose face value here we don't have a rupee signal. Just 1 minute. So face value is 1,000. Okay. Here, today's exchange rate at the time of issue, $1 equal to ₹75. So the investor will pay $1,000 divided by 75, so equal to $1,000 divided by 75 is how much? 1,000 divided by 75.
$13.83, sir.
So 13.33. Okay. 13.33. Now exchange rate. So if it is in between interest, whatever interest that will be paid in dollar. But suppose 10%. 10% on 100 rupees divided by the exchange rate at that time. So just let me, it will be clear if I want exchange rate at the time of redemption. $1 equal to ₹77. The issuer, there is a company will repay the investor 1,000 divided by 77 equal to $12.98, sir. 1,000 divided by 77, 12.99.
Yes, sir.
12.99. So this part is clear. So who has the exchange rate risk?
Investor.
So investor. So biggest advantage of this bond is that exchange rate risk is passed on to the investor. So issuer does not have the exchange rate risk. In case of, that is the biggest problem of foreign currency loan. So which is like this also comes under external commercial borrowing. Okay, so there is a sectoral limit. Everything is there. Huh? So what happens is, but only advantage is in this case is that the exchange rate risk is transferred to the investor. So definition is masala bond is rupee denominated bond. So what is the denomination of the bond? 1,000 rupees, but settled in US dollar. Okay. So, and there is a 5% withholding tax on interest. So when you pay the interest, 5% will be deducted. So the biggest advantage of these bonds are that the exchange rate risk are transferred to the investors, and therefore the cost of raising funds are at least 150 to 200 basis points lower than that of the domestic market. So basically, if you borrow in the domestic market, in the Indian market, whatever is your interest rate, but if you issue these bonds, the interest you can issue at a rate of 15 to 20% cheaper than the domestic interest rate. Now, question is why the foreign investors will buy it. First of all, they are bearing the risk, and after that also they will they are bearing the exchange rate risk. But after that also they will if the rate of interest is low, why should they invest? Now remember, even if the rate of interest is low, that is even higher than the rate of interest which is available in their country. Suppose if you invest in an Indian rupee denominated, if you invest in dollar denominated bond in their country, probably you'll get an interest rate of say 0.5% or maybe 1%. On the other hand, if you invest in masala bonds, probably you as an investor will be getting 4.4% or 5%. Okay, which is lower than the Indian rupee interest rate in the Indian market, but of course higher than their rate. Now they are investing in dollar, though the conversion exchange rate risk is with them. Okay, so that is basically the advantage from both the parties. So for the Indian issuer, first of all, exchange rate risk is transferred to the foreign investors. Number two, the rate of interest at which they can issue the bonds is lower than that of the domestic rate of interest. For foreign investors, though the rate of interest they are getting is, or the the exchange rate risk is borne by them, but still it is higher than their domestic rate of interest. And this also shows the confidence of the international investors in Indian company and its currency. So basically, the international investors will buy these bonds when they will be satisfied with the performance of these currency. So it is clarified by the finance ministry that there will be a withholding tax at 5% on interest income of the masala bonds issued by the Indian companies. Any capital gain from the foreign exchange rate fluctuations between the dates of issue and redemption will be exempt from tax. An issuer can raise martial amounts up to 750 million. As I've told you, that is automatic route for an external commercial bond. So American depository receipts, you have heard about ADR. When an Indian company lists its shares in the American market, it is called ADR, American depository receipts. So ADR is a negotiable certificate issued by a US bank representing a specified number of shares of a non-US company which is traded on an exchange in US. ADRs are denominated in the US dollar. They are transacted in the US stock market like the stocks of any other US company and issued sponsored in US by a US bank or brokerage. Okay, so that's about ADR. How ADRs are issued, I'm just coming. Okay. So for US investors, it is an opportunity to buy stocks of other countries like say Infosys ADRs are listed, okay, in the US market. So they can be listed either on New York Stock Exchange or American Stock Exchange or NASDAQ. NASDAQ is, of course, a stock exchange, National Association for Securities Dealers Automated Quotation. On the other hand, it gives an opportunity of non-US companies to raise money and trade its shares in the US market. Suppose an Indian company wants to raise money through ADRs, the Indian company will issue shares to a depository bank. I told you earlier that depository mechanism. So how it is done, let me tell you. So suppose today one Indian company wants to issue ADR. So it will find a US bank or subsidiary of an Indian bank there. So it will issue the share to that bank. This bank, which is called a depository bank. So shares are issued to the depository bank. Okay. Now this bank will convert the shares into ADRs. Okay. So for example, Infosys, each share of Infosys is equivalent to 2 ADRs. So shares are issued to a bank in America where whatever ADRs. So now these shares are converted into ADRs. So each share of Infosys is converted into 2 ADRs. Okay. So that is what is the depository mechanism. The Indian company will issue shares to a depository bank in US or its custodian in India. The depository bank will issue ADRs to the US investors. The ADRs will be listed and traded in the US exchange or OTC market. The US investors can surrender the ADRs in exchange of the shares. So if US investors want, it can surrender the ADR and get the exchange the shares of the Indian company. But the reverse is not true, possible. When the non-US company directly enters into an agreement with the depository bank or keeping records, communicating to ADR holders, payment of dividend and other services, it is called sponsored ADR. An unsponsored ADR, on the other hand, is a setup without any cooperation of the non-US company and may be initiated by a broker dealer wishing to establish a US trading market. So this is the difference. Level 1 ADRs, you just list your shares, you do not issue. Are the most basic type and may not wish to raise capital. So you list your shares. So they are not listed in an exchange and traded only over the counter market. No information about the issuer companies available in the Security Exchange Commission. Level 2 ADRs are listed on an exchange or quoted on NASDAQ, but may not be used to raise capital. They are required to file annual reports to Securities Exchange Commission. And level 3 ADRs are the most important and prestigious ADRs, and they are issued and to raise money and also trade in an exchange. They are also required to file annual reports to SEC, Securities Exchange Commission. Infosys has level 3 as well as level 2. The depository bank makes an agreement with the issuer company to charge a fee called custodian fee, okay, for the services which are provided by the ADR holders. Sometimes these fees are also deducted by the gross dividend. So suppose whatever is the dividend which is paid by the company, from that they deduct their services and remaining amount is paid to the ADR holder in the form of dividend. Okay. So global depository receipts, American depository receipts is in US, global depository receipts in other countries, and it can be also issued in multiple currencies, multiple countries, multiple stock exchanges. So GDR is a foreign currency denominated instrument issued to the persons who are not resident of India in the overseas market. They are issued to the investors of more than one country. I have already mentioned that, and are denominated in a freely convertible foreign currency. The issuing company issues shares to a depository bank, and against these shares, the depository bank issues GDRs to investors in the foreign country. Each GDR represents a specified number of fractions of shares of the issuing company. Therefore, GDR holders are not shareholders of the issuing company. Like ADR holders are also not shareholders of the issuing company. The depository bank is the shareholders of the issuing company, and it has the voting right. Tata Steel raised $500 million through GDR issued in 2009. So the biggest advantage of GDR is that that they can be issued simultaneously in more than one country and can be listed on exchanges of more than one country other than US. Question. So these are all some of the bonds. Yankee bonds is a bond issued by a foreign entity. Yankee bond issued by a foreign entity, such as a bank or a company, but is issued and traded in the United States and denominated in US dollar. So an Indian company issuing bond in US and traded in US and denominated in US. Okay, it's called Yankee bonds. Samurai bonds, yen denominated bond issued in Tokyo by non-Japanese companies and is subject to Japanese regulations. These bonds are provided with the issuer with an access to Japanese capital, which can be used for local investment or for financing operations outside Japan. Okay. And what is a Shogun bond? Is a bond issued in Japan by a non-Japanese firm and denominated in a currency other than yen. So suppose Indian company is issuing a dollar-denominated bond in Japan, which is listed in Japan, not an yen-denominated bond. Is that clear? So similarly, there can be other of like this. Okay. So State Bank of India issued a bond in Taiwan. Okay. So Formosa bond. Formosa bond is a bond issued in Taiwan but denominated in a currency other than the Taiwanese dollar. So it was issued in dollar. Okay. So similarly, there are different things. Like you have ADR and GDR. So there is something called IDR, Indian Depository Receipts, a foreign company issuing share and listing shares in India is called IDR, Indian Depository Receipts. I repeat, a foreign company issuing shares in India is called IDR. Till now, there is only one company which has issued this, Standard Chartered Bank. So Standard Chartered Bank issued shares in India and listed in Indian stock market. It's called IDR, Indian Depository Receipts. So there can be many more. Just let me touch upon the transfer pricing. So that's the last topic we have, transfer pricing.
Sir, I have a doubt.
Sure.
Sir, in that Shogun bond, it is told like any other currency other than yen, right? So what if we issue a bond
pound, euro,
rupee,
dollar,
like masala bond, basically?
Masala bonds is settled only in dollar.
But that is other than yen, right?
Masala bonds is a rupee denominated bond. And this will be rupee denominated bonds. If you buy masala bonds, written 1,000 rupees. This one is dollar denominated bond.
Shogun, sir, like
Shogun bonds is dollar denominated bond, pound denominated bond, yen denominated, euro denominated bond. Whatever is the currency mentioned, that is settled in that currency also.
Okay, so basically masala bond will not come into Japan.
No.
Okay.
Now, masala bond you can issue in Japan. There is no problem. But in that case, it will be denominated in rupee. Money you can, if you say that it is denominated in rupee but settled in dollar. Okay. So
Yes,
it can be a in that case, it will be a combination of shogun and masala. Anyway. Got it. Name is immaterial. How they are operating is important.
Yes, sir.
So transfer pricing, say, let me just directly give you an example. So suppose tax rate, a parent company, subsidiary company, forget about parent company. Tax rate in this case is say 10%. Tax rate. So here it is 10%. Here it is 30%. The parent company, this is a subsidiary company, or this is a subsidiary company, this is a parent company, whatever is the case. Okay. So now suppose this is in this case, just changing it, this is 30% and this is say 10%. So this is the company and this is the say parent company. Okay. Parent company. So I have, we manufacture something, cost is great here. Cost is 100. Now you transfer profit, say 50. So SP 150 here. So CP of this is 150. Yes or no? From subsidiary it is transferred to parent company. Okay. Yes or no?
Sir, I didn't get this. I was clear till SP.
You are clear till SP. So
yes.
Goods are transferred from subsidiary to parent. So subsidiary selling price is 150. So parent's cost price is 150.
150. Yes, sir.
Okay. So value addition 50. Cost price 200. Now value addition, so make it 30. Cost price 180. Profit 50. Selling price 230. Selling price 230. If you see tax, here how much taxes you pay? On 50, 30%, 15 rupees. Here how much taxes you pay? On 50, 10%, 5 rupees. Total tax?
Sir,
Total
one.
tax? 20? Yes or no? Huh?
Yes, sir.
So if you see the total profit of the parent, here the profit is 50 and here the profit is 50. So net profit (50 minus 15) is 35 here. 50 minus 5 is 45 here. 50 minus 20, 100 minus 20 is 80 here. Okay?
Yes, sir.
35 plus 45, huh? Make
Yes,
sense?
sir. Yes, sir.
So suppose I change in the sense, suppose another one, another example. Or suppose we change to, suppose we change the selling price of subsidiary. Subsidiary makes a profit of 10 rupees. Profit 10. What will be the selling price of subsidiary? Subsidiary has a cost of 100. So the profit is 10, selling price is 110. Okay? So cost price, this is
110.
110. Value addition, same 30. Cost price here
140.
140. Profit same. Now same in the sense the total profit of subsidiary and parent was 50 plus 50, 100. So now the company decided to make the same amount of profit, 10 rupees in the subsidiary country and 90 rupees in this country, in which the selling price remains same. So selling price is same 230. See, selling price was 230, huh? Okay. So I'll continue to make the same selling price. Selling price 230. So tax, here I made a profit of 10 rupees. So 30% of that is 3 rupees. Here I made a profit of 90 rupees. So 10% of that is 9 rupees. So total tax 12. Earlier my total tax was
20.
20. So got it?
Yes, sir.
So will the subsidiary country allow that? So all the multinationals, they keep on calculating what is the minimum amount or maximum amount at which they can transfer the price from subsidiary to parent company, in which there is no complaint. And in fact, there are some agreement also sometimes when you invest in this country. So this transfer pricing advantage is possible only when it is a, only when it is a multinational corporation. So this is what is called transfer pricing. Read slightly in detail. In the book, it is there. So any question, confusion?
No, sir.
So that's all from my side. If you have any question, of course, you can definitely contact me later also. But and this thing, what do you call? I will definitely give you the what you call assignment very soon. yet to decide which assignments will be given. But only thing is, make sure that it is not copied from others. So that's the A. And what else? What else? Wish you all the best. Do well. So that is what I can tell you. Any other question? Anything?
Sir, can you please tell us the question paper pattern for intern?
It will be absolutely. It will be absolutely numerical based. Okay, absolutely numerical. And whatever we have done, it will be from that only.
Okay, sir.
So I have uploaded this what you call it, uploaded the worksheet. All the things I believe are uploaded in Campus 360. Once again, wish you all the best. Do well. Okay.
Thank you, sir.
Thank you, sir.
Sir,
Just confirming there will be no theoretical questions in the final paper, right?
as things stand now, no.
Thank you, sir.
Okay. All the best.
Thank you,
I
sir.
believe before your exam, all of you will be in the campus, so you can always contact me at that time. Okay? If you have any problem. Okay, then bye.
Yes, sir. Thank you.
All the best.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.